We have, this is industry leading. The lowest interest rate we'll charge a borrower on a fix and flip is 6.99%. Does everyone qualify for that? No, they don't. You need experience, a high credit, and money in the bank to do that. But the majority of our customers will qualify for these maximum leverage amounts, and that's 90% of acquisition costs. So they can buy a distressed property with a hole in the roof and a gutted kitchen for a 10% down payment. We'll finance 90%. We'll get a scope of work and budget so we understand what they're gonna, what kind of repairs they're gonna make to the house. We'll finance 95% of the cost to rehab, and our 75% after repaired value, that's our cushion. So as long as 90% of purchase price and 95% of rehab costs, as long as that loan size is less than 75% of what the house will be worth when it's completed, then the numbers work. And typically they do work. If the investor knows what they're doing, they're making the necessary improvements to generate that 25% profit margin cushion, and we're able to work those high leverage figures. All right, here's how we price our line of credit. I touched on it earlier. Not everybody gets the same rate, right? And that's the way it should be. If you have a higher credit score, you have more money in the bank, and you have more experience, you should have a lower interest rate than the guy that just watched HDTV last night and wants to try to be a flipper. We'll make those loans, but we're not going to give them the same price as we would somebody that's done this with a track record over the last 2 years. So number one, we look at experience. How many flips have you done in the last 2 years? How many rental properties do you own today? Liquidity, what do you have in the bank right now? We take 5 times your ending bank balance to establish the line of credit exposure limit. Put numbers there. If a borrower has $100,000 in their January 31st bank ending balance, $100,000 will set up a $500,000 line of credit. If they have $500,000 in the bank ending balance, we'll set up a $2.5 million line of credit. It's that simple. We need 20% of the line of credit amount in liquidity. In other words, 5 times liquidity equals the exposure limit. Credit score will go down to 620, but if you have a 620 score, you're not going to get the same interest rate as if you had a 700 plus score, as it should be. Net worth, this is stated, and I'm going to repeat this. Net worth is stated. The borrower will fill out a personal financial statement and listing their assets and their liabilities. Of course, we do not verify the value of their primary residence or their Mercedes or their jewelry or their boat, but net worth has to be at least 30% of exposure limit. So if you have $1 million line of credit, you need over $300,000 in net worth stated. All right, fix and flip overview. Don't be alarmed by all of this detail and numbers in this column. Rocky's going to send you out this deck so you can review it on your own time. I'm just going to focus, I'll give an overview, but I'm going to focus on the middle column, which is the product that you're going to be selling the most. I just want you to know the other outlying columns, the single loan program and the line of credit non-recourse are available to you, but you're probably not going to do a lot of that business. The single loan program is for an investor that does not qualify for the line of credit. That means they do not have at least $50,000 in the bank, because the line of credit requires a minimum line of credit of $250,000. Do the math. You need 50,000 times 5, 250. That's how you get a line of credit. The line of credit requires experience level of 1. So if you just watched HDTV last night and you want to be a flipper and you've never done it before, then you do not qualify for the line of credit. We only give that product to somebody with experience, but you do qualify for the single. So if you run through the single column, look at the leverage percentages, 70% of ARV instead of 75, 85% of cost instead of 90, all right? So you get the picture. You don't get as much leverage, and the interest rate is higher on the single. Same thing on the line of credit non-recourse. We haircut the LTV exposure limits if the borrower is not personally guaranteeing the loan. So your borrowers are going to fall in the middle. 95% of our business is right in the middle of the line of credit. Minimum loan size, $50,000. We'll go up to $2.5 million per property. We'll set up a line of credit up to $10 million. If you want more than $10 million, you have to move over to the non-recourse, because we'll go up to $100 million on the non-recourse. We charge interest on the amount that you pull out, not the line of credit. So if you pull out $200,000 for a project, you're paying interest on 200,000. Even if you have $1 million line of credit, you're only paying on what you use. You see the leverage percentages. We go to borrower types. We'll make loans to an individual all the way up to an LLC, series LLCs, corps, and some trusts. Eligible properties. Let's spend some time on this. Although Finance of America Commercial is in my name, I do not do office buildings, strip malls, industrial parks, anything commercial related. We make commercial loans to real estate investors on residential real estate property. The best way to remember it that I figured out that I told myself a couple of months ago is we make loans to people on property that people live in, not work in. So if people or renters can live in the property, that's a residential property. If they go to work in that property, I'm not lending on it. That's commercial. We'll go up to, on the line of credit, multifamily, small apartment complexes all the way up to 20 units. No exception. We're not doing over 20 units. But if you have a multifamily 7-unit building or a 20-unit apartment complex, we'll lend on that. No prepayment penalty on the line of credit because we expect to get paid off. We set the line of credit up for 9 months and 12 months on if it's ground up construction. And if they need an extension, we offer 3-month extensions. We have full appraisal. That's how we get our as-is and after repaired value. We send the appraiser out with the scope of work budget that the borrower gives us. We give them the purchase contract and the scope of work budget. Scope of work budget is an itemization of the work that they plan on doing. For instance, new roof, $10,000. Kitchen bath remodel, $12,000. Carpet and paint, $5,000. The appraiser uses that scope of work, and then they give us as-is value today, and then they look for comparables that have had similar improvements in the neighborhood, and they come up with after repaired value. So we know when the appraisal comes back what our leverage, we plug in our leverage percentages on the purchase price and after repaired value and what we can finance for the rehab. All right, moving on. I'm a visual person, so I like to put numbers to how all this works. And once you do a couple of these deals, this will make more sense, but this will help you. Let's say we have a traditional fix and flip. They're going to buy that distressed property for $100,000. They're going to put 50 into it. I can lend 90% of what they pay for it as is value, 95% of rehab cost, as long as my LTV after repair value is 75%. They think the house is going to be worth 200, so they'll buy it for 100. They'll put 50 in it, and they'll have a nice margin, $50,000 profit. How do we work the numbers here? We'll lend $90,000 of the acquisition. They come with $10,000. We'll lend $47,500 because it's a $50,000 rehab. They pay the $2,500 out of their own pocket, and we finance 95% of the rest of it. And do the numbers work? Well, take 75% of 200, that's $150,000. As long as my acquisition loan of 90 plus my rehab loan of 47.5 is less than $150,000, we're good, the numbers work. If they were not, and the after repaired value was less than 137, what happens then? It's real simple. We'll still lend the 90,000 on the acquisition, but we will not have enough equity to lend the 47.5. Maybe we're only going to have enough equity to lend 90%. So they'll have to bring a little bit more money to the table for the rehab. Not to the table, not to closing, but they'll have to pay the contractor because we're only going to finance a certain amount of the total cost, and they'll have to come with more. The good news is there's no surprise here. They're going to know right when the appraisal comes back. So we get the appraisals back within a week. So they can make amendments. They can, well, maybe they're over improving. Maybe they shouldn't do the level 4 granite and the hardwood floors and scrape the popcorn ceilings, because what it's telling us is they're over improving that house for the neighborhood, and they can't get that return on investment in that particular property in that particular neighborhood. Novice investors make that mistake all the time. Experienced investors don't. They know exactly what improvements to make to generate the highest rate of return on the property. All right, we're done with fix and flip. New construction is part of the line of credit product. So it's very similar to the fix and flip line of credit that we just went over. It just has a little caveat. It's got land value. So we can lend 75% of the value of the lot. which is if they own the lot now, we can immediately cash them out of 75%. And we can lend 95% of construction costs, just like 95% of rehab costs, same thing. LTV, not to exceed 75. That's our cushion and their profit margin. So we have recourse single loan and we have recourse line of credit. So what I'm saying here is we will do a new construction loan to somebody that doesn't have any experience. But as I said before on the previous pages, the leverage points are going to be less and the interest rate's going to be higher, but it is available for somebody that wants to get started. Let's stay with the line of credit recourse. Line of credit gets the best price and the highest leverage. So new construction is best suited for developers or investors building 1 to 5 properties at a time. Scattered lots are okay, infill lots are okay. Construction has to begin within 3 months of financing the lot. So they can't buy a lot and sit on it because we don't want to be in the lot business. We want to be in the ground up construction business. But 3 months is plenty of time for them to acquire the lot, get it permitted, and start vertical construction. Minimum loan size 150. We're not going to go through the processing and the underwriting for anything less than 150. Whereas we'll go to 50,000 minimum on the fix and flip line of credit. New construction is I don't think you can build a house for that less than that. Line of credit we'll do 250,000 up to 10 million, just like the previous one. Same LTV, 60% with permits and 75 without. Here's what that means. If a borrower wants to purchase a vacant lot and it's currently not permitted, that means they've got a little bit more time to get it permitted, and we're going to have to wait a little bit longer. We're only going to lend 60% of that. So if they want to take down a vacant lot without permits, which typically on a purchase, they're not going to be permitted. They're going to have to put 40% down. We'll lend 60%. Once permits are in hand, we'll release the other 15% of them. So we will lend 75% of the value of the lot once it's permitted. Everything else is the same as the others in terms of property. Look at the left column under eligible property types. We will allow construction and financing of multifamilies up to 20 units only on the line of credit. We're not going to let a first-time home investor build a home anything more than a 4-unit apartment building, or I should say 4-unit duplex or triplex or fourplex. Minimum credit score 620. All right, here's an example. Let's say the land is worth $100,000 and it's going to cost $200,000 to build. We'll lend 75% of the value of the land if it's permitted. Construction, this particular borrower is 90%. Maybe the credit score was in the 680 bucket instead of the 700 bucket, which will cause the LTV to come down to 90 instead of 95. That happens sometimes. But let's say the house will be worth 350. So the land's worth 100. It's going to be 200 to build, and there's a $50,000 margin. So we'll lend 75,000 if it's permitted, 60,000 without permits. We'll lend 180,000, which is 90% of the 200 cost to build. And let's run our numbers. The after repaired value is 350. Take 75% of 350, which is 262.5. As long as our land loan plus our construction loan is less than 262.5, then all the numbers work for maximum leverage, and in this case they do. All right, we're done with fix and flip. We're done with new construction. We're moving on to rental property loan, and we're at 10:30, so we're doing good. We got another 15 minutes or so.